Welcome to our channel EdVantage. Learning made easy. This video discusses Chapter 9 of Module 5, that is Currency Market. So let us begin. The contents of this chapter are as under. Salient features of Euro-dollar market are as follows. Wholesales market. International market. No national control. Short-term money market. Highly competitive and sensitive market. Salient features of Euro-dollar market are discussed in detail as follows. 1. Wholesales market. The Euro-dollar market is dealt in large units, that is, individual transactions are usually above $1 million. 2. International market. The euro currency market emerged as the most important channel of mobilizing funds on an international scale. 3. No national control. The euro-dollar market is outside the direct control of any national monetary policy. 4. Short-term money market. Euro-dollar deposits are predominantly a short-term investment, that is, they range from 1 day up to 1 year. 5. Highly sensitive and competitive market. It is reflected in the responsiveness of the supply of and demand for funds to changes in the interest rates and vice versa. Factors contributing to growth of the euro-dollar market. Balance of payment deficit of USA. Banking regulation in USA. Innovative banking. The Suez Crisis. Relaxation of exchange controls. Political factors. Supply of petrodollars. Supply and demand. Factors contributing to growth of the euro-dollar market are discussed in detail as under. Balance of payment deficit of USA. The large and persistent deficit in the BOP of USA increased the flow of US dollars in such countries having surplus BOP. Innovative banking. The advent of innovative banking headed by American banks in Europe encourages the growth. Relaxation of exchange controls. Relaxation in exchange control, stability in exchange market and resumption of currency convertibility. Supply of petrodollars. Flow of petrodollars by the tremendous increase in OPEC oil revenue following frequent hike in prices has been significant factor. Banking regulation in USA. Issuance of Regulation Q in USA, which fixed minimum rate of interest payable, which contributed to the growth. The Suez Crisis. The Suez Crisis in 1957 placed restrictions upon the sterling credit facilities for financing trade. Political factors. The Cold War between the US and communist countries also contributed to the growth of euro-dollar market. Supply and demand. The demand from governments, international organizations, central banks, MNCs, commercial banks leads to growth. Problems created by euro currency market. Reduces the effectiveness of domestic stabilization. For example, large firms cannot borrow domestically because of credit restrictions. Frequent and large flows of short-term euro currency funds from one international monetary center to another, which produce great instability in foreign exchange rates and domestic interest rates. Euro currency markets are largely uncontrolled, as a result of which the worldwide recession may lead to insolvency of the banks. The segments of euro currency market includes euro credits, euro bonds, and euro currency deposits. 1. Euro credits. Euro credits are medium and long-term loans involving large amount which provided in the euro currency market. It is provided without any collateral security. Emphasis is laid on the credit rating of the borrower. Euro credits are normally provided in two forms. Revolving credit. It is similar to cash credit facility. Interest is charged on actual amount utilized, plus a commitment fee may be charged on unutilized portion. Term credit. It is similar medium-term loans provided by banks. This provision helps the borrowing companies to repay the loan and avail of better conditions that may prevail in the market at a later date. Most of the credits are for 5 to 8 years and extends up to 15 years. Interest is fixed at a certain percentage, generally the interbank rate for euro currency deposits. Many of the loans raised are in dollars, and for such loans the reference rate is Libor. The borrower is given the option to roll over the loan in different currencies according to his requirements so as to avoid exchange risk. 2. Euro bonds. The euro bonds are international bonds. They are the main source of borrowing in the euro markets. Euro bonds are unsecured securities. When they are issued by the governments, corporations and local bodies, they are guaranteed by the government of the country concerned. Most of the euro bonds are issued in US dollars in denominations of $10,000. The average maturity of euro bonds is 5 to 6 years and the maximum maturity is 15 years. There are 4 types of euro bonds, which are as follows. Straight or fixed rate bonds. Fixed interest bearing securities. Maturity range from 3 to 25 years. Convertible bonds. Fixed interest bearing securities. The investor has the option to convert them into equity share of the borrowing company. Currency option bonds. It is similar to straight bonds. Difference is that it is stated in one currency with the option to take payment of interest and principal in second currency. Floating rate notes. They occupy a prime position in the euro bond market. It is similar to straight bonds except that varying rate of interest as per market conditions is paid. 3. Euro currency deposits. The euro currency deposits represent the funds accepted by the banks themselves. These are the most important investment in the euro-dollar market. Call deposits. It may be made overnight, 2 days or 7 days notice for US dollars, Canadian dollar, sterling and Japanese yen. Time deposits. It is accepted for a period of 1, 3, 6 and 12 months for all currencies. Deposits in US dollar and pound sterling can be placed for periods up to 5 years. The minimum size of deposit in euro currency market is $50,000 or its equivalent. The interest rate in euro currency market are determined by the factors which affect the demand and supply conditions of the currency concerned, namely volume of world trade transacted in the currency, domestic interest rates, domestic monetary policy and reserve requirements, domestic government regulations, relative strength of the currency in the foreign exchange market. Currency areas. An optimal currency area, OCA, is the geographic area in which a single currency would create the greatest economic benefit. While traditionally each country has maintained its own separate national currency, work by Robert Mundell in the 1960s theorized that this might not be the most efficient economic arrangement. In particular, countries that share strong economic ties may benefit from a common currency. This allows for closer integration of capital markets and facilitates trade. However, a common currency results in a loss of each country's ability to direct fiscal and monetary policy interventions to stabilize their individual economies. Illustration 1. Initially Region A and Region B have full employment and balance of payment equilibrium. This equilibrium is disturbed by a shift in demand, from goods of Region B to the goods of Region A. The shift of demand from B to A causes unemployment in B and inflation in A. If it tightens its credit restrictions to prevent prices from rising, then B has to adjust itself, otherwise unemployment in B would further increase. Such a problem is faced by countries with different currencies wherein unemployment in deficit country is corrected by inflation in surplus country. Illustration 2. Where the regions within a closed economy have a common currency and national government pursues a full employment policy, then shift of demand from B to A causes unemployment in B and inflation in A. To correct the unemployment in B, the monetary authorities increase the money supply. The monetary expansion leads to inflationary pressure in Region A. However, A currency area of either type cannot prevent both employment and inflation amongst its members. International financial integration. Euro has become the second most widely used currency. Euro contributes towards providing price, fiscal and financial stability. The international role of Euro is determined by decisions of market participants. A credible monetary policy focused on internal price stability enabling reduction of public debt. European Central Bank's monetary policy strategy, instruments and procedures are capable of internalizing implications of international role. Euro plays a role as a peg in 55 countries outside the Euro area. The Euro accounts for the fifth of the global foreign exchange market turnover. Future developments with regards to private international use of the Euro are likely to be heavily influenced by two main factors: size and risk. Thank you for watching our video. Stay awaited for our next video and please subscribe to our channel EdVantage.